All right, let's dive into Commerce Inc.'s latest quarter. Now, when you first look at the numbers, it's kind of confusing. You've got these awesome profits on one hand, but growth has totally flatlined. So what's the real story? Well, it turns out management is betting the entire company on a huge pivot to AI. So we're going to break down exactly what that means and what it could mean for the stock. So, this is really the whole story in a nutshell. It's like a tale of two completely different companies. On the one hand, look at that operating profit. They reported $8 million when they only guided for $3.5 million. That's a huge beat, right? It shows some serious discipline. But then you look at the other side, growth. The annual recurring revenue, or ARR, is up only 2% year over year. I mean, it's basically crawling. So this is the big question we all have to ask. Is this just smart cost control, or has the growth engine completely seized up? Okay, so how does management answer that question? Well, they're basically telling investors, hey, don't worry about those growth numbers right now. Look over here at the future. And that future has a pretty cool name, agentic commerce. This is the bull case for the stock, the optimistic story. And believe me, it was pretty much all they wanted to talk about on the earnings call. So what in the world is agentic commerce? Well, think about it like this. It's a bet on a future where you stop browsing a dozen different websites to find something. Instead, you just talk to an AI. You tell ChatGPT or Gemini or whatever agent you're using what you want, and it does the shopping for you. In that world, your company's flashy website doesn't matter nearly as much as the quality of your product data. The whole game changes from getting clicks to just feeding these AIs the best, most accurate info possible. Yeah, this slide lays it out perfectly. The old way, that's what you and I do every day, right? We're manually searching, clicking through pages, comparing prices. It takes forever. The new way is just talking. You give a prompt to an AI like, find me the best running shoes for a marathon under $150, and bam, it does the work. Commerce Inc. is going all in on this, betting that their Feedonomics data engine will become the essential plumbing that makes this whole new world work. And look, they're not trying to do this alone. That would be crazy. Their whole strategy, as you can see here, is to weave themselves right into the fabric of this new AI ecosystem. They're partnering with all the big names, PayPal, Perplexity, Microsoft, Google, you name it. The play here is to make their data so essential that it doesn't matter who wins the AI wars. They want to be the one company everyone has to use. Okay, that all sounds amazing, right? A big, bold vision for the future. But a vision doesn't pay today's bills. So it's time for a reality check. Let's pull back from that future story and look at the numbers for the core business because, frankly, this is what has investors really worried. And here it is. This is the chart that's causing all the heartburn. That annual recurring revenue, which, is the lifeblood for a software company, grew just 2%. From $349 million to $356 million in a whole year. I mean, for a company that used to be a high-growth darling, this kind of slowdown is a massive, massive problem they have to solve, period. And if you dig a little deeper, it gets even more concerning. They actually lost enterprise customers last quarter, a 5% drop. These are their big, high-value accounts, so that's a really bad sign. Even the CFO had to admit on the call that the core business has been, and I'm quoting him here, a little bit tougher. Honestly, that's putting it mildly. This is a trend that they have to turn around, and fast. Now, to be fair, management isn't sticking their heads in the sand. The CEO, Travis Hess, came right out and said it on the call, plain as day. We need to grow faster, and we need to do so more profitably. So hey, at least they're acknowledging the elephant in the room. But saying it is one thing. The market is waiting to see the plan to actually do it. So what is the plan? Well, they laid out a three-pronged strategy that's supposed to be the bridge from where they are today with this super slow growth to that big AI future they're talking about. So let's break down what those three pillars are. Okay, here's the game plan. Number 1, product-led growth. They're launching a free tool, Feedonomics Surface, to basically get more people in the door. It's a classic top-of-funnel play. Number 2, they're unbundling products. Instead of making you buy the whole suite, you can now buy tools like order orchestration a la carte. That should open up the market to smaller customers. And number 3, new payment partnerships. This is a big one. They're launching a new service with PayPal in 2026, which should create a whole new way for them to make money. So, if you boil it all down, what's the big takeaway here? It's that they are totally overhauling their strategy. The old way of hunting for those giant new enterprise whales, it's just not working anymore. It's too slow. The new model is all about using their products to attract users, and then selling more stuff to the tens of thousands of customers they already have. It's a much smarter, more scalable way to grow. That is, if they can pull it off. All right, let's bring it all home. This brings us to the verdict. How do you balance this really exciting long-term AI story with the pretty grim reality of their current growth? That's the million-dollar question, so here's our take on what comes next. So for Q4, our prediction is pretty muted results. And here's why. Management gave this super wide guidance range. We're talking a $5 million spread on the forecast. Now, the CFO said it's just because the holiday season is unpredictable, but for us, a range that wide screams that they just don't have a great handle on the business right now. And that means we should probably be cautious. So what does that mean for the stock price? We think it's going to be pretty much range-bound for a while. Think of it like this. That big AI story puts a floor under the stock. It probably won't totally collapse, but the lack of growth right now puts a hard ceiling on it. So it's probably just going to trade sideways until the company can show us some real tangible proof that these new plans are actually starting to work. And that brings us to our final rating, market perform. It really feels like the right call here. Why? Because you have this perfect balance of risk and reward. The opportunity with this agentic commerce stuff, it's huge, no doubt. But the risk that they can't fix the core business is also very, very real. So until we see some actual proof that growth is picking back up, we think the stock is just going to perform in line with the rest of the market. And of course, we have to end with this crucial reminder. This is not financial advice. This breakdown is just for informational purposes. You should always do your own homework before making any investment decisions.